Do you know what factors affect your credit score and how to improve it? Let's dive into the world of credit scores, a pivotal factor in your financial health. Just as your physical health depends on various factors, your credit score is also influenced by multiple elements. It's not just about how much money you have in the bank or how timely you pay your bills. A credit score is a numerical representation of your credit worthiness, and it's something that lenders, landlords, and even some employers might check. It's like your financial report card, and it can impact everything from the interest rates you're offered to your ability to rent an apartment. Understanding the factors that influence your credit score is crucial. It gives you the power to improve your score and consequently your financial opportunities. It's like knowing the rules of a game and playing it to your advantage. Stick around to discover the key factors that impact your credit score and how you can manipulate them to your advantage. Your credit score isn't just a random number, it's calculated based on 5 key factors. First off, we have payment history. This is the most significant factor and makes up about 35% of your credit score. It evaluates whether you've paid past credit accounts on time. Essentially, lenders want to know if you're reliable, and your past behavior is often a good indicator of future actions. Second on the list is credit utilization. This is the ratio of your outstanding credit balances to your credit limits, accounting for approximately 30% of your credit score. It's recommended to keep this number below 30%. High credit utilization signals that you may have trouble managing your debt, which can be a red flag for lenders. Thirdly, we have length of credit history. This contributes about 15% to your credit score. It considers the age of your oldest credit account, the age of your newest one, and the average age of all your accounts. Longer credit histories tend to show you're more experienced with handling credit, which can be a plus in the eyes of lenders. The fourth factor is new credit, which represents about 10% of your credit score. This refers to how often you've applied for and opened new credit accounts recently. Each time you apply for credit, a hard inquiry is made, which can temporarily lower your score. So avoid applying for new credit too frequently. Finally, we have credit mix, also accounting for 10% of your score. This considers the different types of credit you have, including credit cards, retail accounts, installment loans, mortgage loans, and others. A diverse credit portfolio can indicate that you're able to manage different types of credit responsibly. Knowing these factors is the first step to improving your credit score. Let's dive deeper. Payment history is the most influential factor, but what does it really mean? Well, in simple terms, payment history is a record of your consistency in paying off your debts on time. It's like a report card that reflects your financial discipline and reliability. The credit bureaus, the organizations that compile your credit reports, keep a keen eye on your payment history. They monitor whether you've been making your credit card payments, loan installments, and other debt-related payments on time. Now you might be wondering, what happens if I miss a payment or make a late payment? Unfortunately, late or missed payments can harm your credit score significantly. That's because they indicate financial irresponsibility, making you a potential risk in the eyes of lenders. Remember, even a single missed payment can stay on your credit report for up to 7 years. So, it's best to make all your payments on time, every time. Maintaining a consistent payment history is crucial. Next, we'll look at credit utilization. Credit utilization is another important factor, but how much is too much? Let's dive in. Credit utilization refers to the percentage of your available credit that you're currently using. For example, if you have a credit card with a $4,000 limit and you've charged $2,000, your credit utilization is 50%. Now why does it matter? Well, high credit utilization can signal to lenders that you're over-reliant on credit and potentially a risky borrower. That's not a message you want to send. So, what's the ideal credit utilization ratio? Most experts agree that it's best to keep your overall credit utilization ratio below 30%. That means if you have a $10,000 credit limit across all your cards, try to keep your balances below $3,000. Remember, not only is it important to pay your bills on time, but also to monitor how much credit you're using. Keeping your credit utilization low is key. Let's move on to the length of credit history. The length of your credit history also plays a part, but why does it matter? Well, the answer lies in how it reflects your financial behavior over a significant period of time. The longer your credit history, the more data there is for lenders to assess your credit worthiness. Consider it this way. If you've managed credit responsibly for 20 years, it speaks volumes about your financial discipline. It's like a track record in the financial world. On the other hand, a short credit history doesn't provide enough information for a lender to make a confident decision. Having long-standing credit accounts also has its advantages. It shows that you've maintained a relationship with a lender over a lengthy period, which is a positive sign to potential lenders. It's important to understand that closing old accounts can actually shorten your credit history, potentially impacting your credit score negatively. A long credit history can boost your score. Now let's talk about new credit. New credit can be a double-edged sword. But how does it affect your score? It's a question that keeps many financially savvy individuals up at night. When you open a new credit account, it's like sending out an invitation to credit bureaus to take a closer look at your financial behavior. Each new account lowers your average account age, which can impact your credit score negatively. This is especially true if you don't have a long credit history. There's another aspect to consider. Each time you apply for new credit, a hard inquiry is made. These inquiries stay on your credit report for 2 years and can cause a small, temporary dip in your score. Applying for new credit too frequently can make you seem risky to lenders, which can lead to lower approval rates. But remember, new credit isn't all bad. It can help diversify your credit mix and demonstrate responsible borrowing habits. New credit should be managed wisely. Lastly, let's explore credit mix. Credit mix might seem confusing, but what role does it play in your score? Well, let's break it down. Credit mix refers to the variety of credit types that you have. This includes revolving credit, like credit cards, and installment loans, such as mortgages or student loans. It's not just about having credit, but also about how you manage different types of credit. Lenders like to see that you can handle a mix of credit products responsibly. It shows them that you're experienced in managing your finances, and this can have a positive influence on your credit score. Having a diverse credit portfolio has its benefits. It allows you to show lenders that you're not reliant on one type of credit. This diversity can demonstrate financial maturity and stability, which can make you more attractive to lenders. Remember though, not to take on more credit than you can handle just to improve your credit mix. Always borrow responsibly. A diverse credit mix can enhance your score. Let's summarize what we've learned. So, we've covered the key factors that affect your credit score. Let's recap. Firstly, we delved into the importance of payment history, the most influential factor in your credit score. It's essential to pay your bills on time, every time. Even a single late payment can have a significant impact. If you've missed payments in the past, don't worry. Consistency can help you recover over time. Next, we unpacked the mystery of credit utilization. This is the ratio of your outstanding credit to your total available credit. It's recommended to keep this ratio below 30%. If you're over this limit, consider paying down your balances or requesting a credit limit increase. Then, we discussed the length of your credit history. The longer your credit history, the better. But remember, it's not just about how long you've had credit. It's about how well you've managed it. We also examined the impact of new credit. While opening a new credit account can temporarily lower your score, having a mix of credit types can actually benefit you in the long run. However, it's vital to avoid unnecessary credit inquiries and only open new accounts when needed. Finally, we explored the importance of credit mix. This refers to the different types of credit you have, like credit cards, mortgages, or student loans. A diverse credit mix can reflect positively on your credit score, as it shows lenders you can handle different types of credit responsibly. In conclusion, improving your credit score is not a quick fix, but a journey. It requires consistent effort and responsible financial behavior. Remember, the 5 key factors: payment history, credit utilization, length of credit history, new credit, and credit mix, all play a significant role in determining your credit score. By understanding and managing these factors, you'll be better positioned to achieve your financial goals. By understanding these factors, you can take control of your credit score and improve your financial health. Thanks for watching.